Thank you so much, Aditya. And
Right.
thank you so much, Shiv. Actually, questions have already started to come in my direct message on LinkedIn. So it's rarely to see that before the session begins, the question starts coming in. But a very warm welcome to all of you who are joining us live for this fireside chat on day of finale of 8th Indian Alternative Investment Summit 2021. As you all know, it's on a pertinent topic, changing global macro landscape and its impact on Indian AIFs. As Aditya mentioned, I'm Jyoti Rai, your host for this session. For next 20 minutes, I will be in conversation with our guest, Shiv Segal. As you all know, he is the president and head institutional securities at Edelweiss Wealth Management. With over 2 decades of experience in investment and financial services, Shiv, in his current role, provides leadership to one of the India's largest equity franchises and is responsible for capital market businesses, which includes institutional equities and asset services. Prior to Edelweiss, Shiv led the Goldman Sachs institutional sales trading equity capital market business in India and was responsible for firm's franchise relationships. Shiv was also appointed to the Goldman Sachs India board to oversee day-to-day operations and provide executive leadership on various committees. He is a CFA from CFA Institute US. There is more to his embellishments, but I can't wait to invite him and thank him for having this conversation on this platform. Hi, Shiv, how are you?
Thanks, Jyoti. Thanks for those humble words. Let's get cracking. I think, as you said, I think the audience would love to go through what we have to discuss. But thanks for that.
No, no, certainly. So I'm shooting my first one to you, Shiv. The second wave, as we all know, has been very demoralizing for the country, for all of us. And we stand in the midst of another severe wave. How do you think the market is reacting this time versus the first wave that we saw last year, and why?
So I guess if you look at the large fiscal stimulus underwritten by central banks, and the faster rollout of vaccinations have enabled economic activity to recover very strongly across the developed markets, especially being led by the US. However, the very recent impact of the second wave in emerging markets and particularly in India, it is more apparent. Where just as economic activity was recovering, if you roll back to what was happening in January, February, the second wave has seriously undermined both the health infrastructure and the ongoing recovery. While one remains hopeful that the prospects of the quick rollout in terms of vaccinations and the localized nature of lockdowns, which we are seeing this time around, will relatively keep economic activity levels on track as compared to the previous year, which was basically there was no rule book written. When we got hit last March, I guess the human cost as well as the permanent scars on potential growth are very difficult to estimate. From an economic standpoint, from a market standpoint. But if you look at the markets, the reality is that headline indices have only modestly corrected, and I'll talk a little bit about why. But the sectors most hit by the lockdown, such as services and banks, have actually seen sharper cuts, despite having very robust earnings this season around. Also, I would like to put things in context. Investor sentiment was probably at the best in terms of euphoric levels at around January, February. The calendar year started with almost everything in place for Indian equities to have a very, substantial bull run. COVID cases were declining, emerging markets in general were doing well. Global investors were pouring in money. We had seen about $23 billion come in the December quarter. And let's add to the fact that the budget this time was very, very robust, very dynamic. Most market participants felt that the government had done the right things, and market sentiment at that point was very good. What we have seen over the past few weeks is a natural and much needed moderation of that sentiment that probably was at the peak in January, February. I guess the negative catalyst for the correction came in the form of rising global yields first, and this ongoing number of cases rise has actually kind of dented sentiment a fair bit. In the near term, I guess the progress on the second wave, the associated economic restrictions, and I guess the pace of the vaccination in India remains the key monitorable in terms of market participants and how we do that on the domestic front. Also, very important to note that this time around, the market has a precursor to follow in terms of what transpired in March of last year. We saw a very, very robust demand bounce back, and the economy adjusted fairly quickly. And market participants are actually looking forward to that, extrapolating that experience this time around as well. And that is why we are not seeing the pullback that a lot of market participants expected. I'll add to the fact that despite the extent of institutionalized selling, both from domestic and foreign, the local demand has absorbed that really well. There is a narrative shift on the underlying current theme. And, actually, NSE came up with some stats last week alone. And the retail participation in India has actually moved from 33% market share in cash market from 2016 to almost 45% in 2021. Now, this is not just an Indian statistic in terms of the trend. We have seen a very similar trend in developed markets as well, especially in the US. And I guess this difference has played out a significant role in curtailing the deep correction. If both domestic and foreign institutions were selling, we could have seen a much sharper pullback. So as I said, I guess everyone is watching how the vaccination and the platooning of the cases happens, but we are still in a very precarious situation in those terms.
Thank you, Shiv. That is a very well defined, laid out sense of what's going around. While the majority of world has seen COVID as a major risk, but speaking of assets, some of the global risk assets has seen this crisis as a boom. Why so? And do you see these trends more enduring or they are temporary, so to say?
That's a great question. I guess the last 12 months, I think in terms of risk appetite, market sentiments, has kind of, it's taken everyone by surprise, right? Let's not forget that we have in capital markets the first time all the central banks in unison printing money, right? I have not, I don't think we can go back to history textbooks of economics to see the amount of liquidity pouring into markets has been unprecedented, right? And as a result, that ignited animal spirits, and we have seen what is happening in terms of not just equity markets, but what's happening in the digital space as well with Bitcoin and cryptocurrencies, and we can talk a little bit about that later. But this unprecedented jump in global money supply is been very essential for global reflation and risk assets. This, in my view, is a core structural change, as the new administration in the US, clearly wants a larger government role and is focused on reducing inequality as well. I think they're on a path which we will only see the Fed balance sheet rise and rise, at least in the near term. Powell has said that he's not even thinking about raising rates. Yes, there are pockets where I think things are getting overheated, and they have been overheated for a while. But unless unemployment and world growth, come back to a normalcy and look stable, I don't think the central banks will pull the lever just in terms of taper tantrum or anything, even indicating in those terms. I think that's probably a story for late 2021, early 2022.
Right. So thanks, Shiv, for that. We spoke about a humongous amount of investments coming into Indian markets. You just mentioned about the $1 billion, the huge liquidity that is yet to come into Indian markets. But overall, this question, Shiv, is to do with Indian economy recovery, which most of the people are asking today. That how do you see Indian economy recovery playing out in the current global setup?
So I guess India will be the biggest beneficiary and will definitely see spillovers of the global reflation that we have seen in the last couple of months, right? I think the impact on Indian economy is slightly underappreciated. I think if you go back to the economic boom that happened in the early 2000s, those were the similar factors that led to the GDP and the Indian economy doing very well. And I think the spillover that I'm talking about, we could factor that into three things. I think the three channels that I watch out for are capital flows, trade, and prices. Firstly, improving global monetary tide has lifted almost everywhere world trade, right? Which in turn will also drive Indian exports and manufacturing capability and utilization rates higher. We are already seeing that in this earnings cycle, and companies alluding to that fact as well. Secondly, this along with the improved prices will lift nominal cash flows and sentiments, thus leading to a better outlook on the capex front, which has basically not happened in India in the last 4 or 5 years. And finally, strong flows should result in the banking system having abundant liquidity. With RBI also introducing measures, they have every time they feel that there is. I think what has impressed me also is that they have been a lot more proactive rather than reactive in the last 9-12 months. And this macro environment, along with the clear pathway that the Indian government and the RBI has shown, I think augurs well for the Indian business cycle, especially the banking sector in the longer term. In the short term, yes, with the second wave ongoing, there will be question marks, into how it plays out in the short term. But I'm a firm believer of the Indian story. I think this decade is for India. I think in a couple of months' time, COVID-19 will be behind us. As the vaccination rollout happens, India has lagged behind in that. Yes, we could have done a far better job in the last 9, 12 months regarding that. But if you look at, one stat that nobody's talking about, uh, that despite the year that we had, if you look at the IPO market, which is primary insurances, the market participants showed tremendous faith in that in India. I think we had about 14 or 15 decent IPOs in India, and the total amount raised was almost 27,000 lakh crores in India, right? With an average listing gain of close to 40-45% in these IPOs. I think this shows that market appetite has been extremely strong. Also, the fact that global IPOs have also done exceptionally well. But we have also seeing hybrid InvITs getting a lot more traction. Actually, Edelweiss just closed along with a few other bankers the Power Grid InvIT, which saw robust demand. And we are also seeing a lot of unicorns coming into the Indian markets to list. I think Zomato filed this week, Nykaa will file soon. All of this signals a journey towards the majority of the primary markets in India as well. So I believe, a lot of market participants have talked about, Indian economy going to 5 trillion, and that's a number that's being talked about by the government as well. Yes, COVID-19 has kind of delayed the pathway to that, but the structural growth story is very much intact, right? We have all the levers in place. We just need to wait out the pandemic and hope things normalize soon. But yeah, I remain optimistic, for this decade.
Yes. Shiv, knowing you, of course, very optimistic, and you have always been a hard hitter when it comes to India. You have been keeping the flag high of Indian markets, and I've always seen you bullish and realistically bullish. Now that we are speaking about growth of asset classes, new opportunities being hit in the market like IPOs, and the fundraising has been so robust, how do you think the next decade will be from the past in terms of the asset classes?
Well, in the previous decade, there was once big safety trade with bonds doing very well, right? And the US markets post the global financial crisis on a one-way trend, followed by equities and then commodities, which have only kind of taken off in the last 1 year. I think that flight to safety trade is slightly over. There will be larger concentration in assets within equities. It's the defensive and then US equities, which did very well. And EM assets have struggled with hardly any US dollar returns in the last 10 years. And I believe that if an asset class has been on a downtrend or has consolidated in terms of time correction and not just price correction for 10 years, it'll probably do a lot better in the next 10 years. So I think, in my view, EM assets are better poised than DM for the next, in this decade. And within equities, I think global cyclically are better poised than defensives.
Mm.
And I'm a firm believer that this decade will also see the trend that the millennials have caught on, right, in terms of digital assets and blockchains. Yes, there is too much going on there, but some of them are actually well defining and actually solving a lot of the issues that have been in the old system, and those ones will come out as the forefront. And it definitely makes it prudent to have some sort of allocation there as well.
Fantastic. So sure, it's alternatives extravaganza, so to say, that is unfolding for the next decade, if I can interpret your signal shift. Another pertinent question that is making a lot of rounds and people want to ask from you is, how do you see Indian equities performing over the next couple of years? With the index at such a stratospheric earnings multiple, do you think corporate earnings will have a lot of catching up to do?
Well, if you look at current levels of Nifty, in Nifty is trading on almost 21 times next year forward earnings. Earnings so far this season have been broadly in line with expectations or marginally subdued, mainly in the IT and auto sector. Um, but they have, expectations were built in very robustly. I think the initial commentary from large private sector banks has also been very encouraging in terms of NPAs and growth trends, and I would expect this to continue. As I said, the global reflation is seeing the metal sector post its highest profitability in almost two decades. I would expect this to continue over the next 2 quarters as well. I think, given what is transpiring in terms of COVID, and minor lockdowns state-wise, I think the automobiles and FMCG sectors will get impacted. Also, there is raw material pressure there as well. But undoubtedly, if you look at the metric in terms of where we are in terms of yields, right? With global yields and US 10-year yields returning almost negative, it becomes imperative to look at where we are in terms of relative valuations, not just absolute. And what excites me most is the fact that we have seen a downtrend in terms of corporate profitability to GDP for almost 2 decades. And most corporations have gone through a massive cost cutting exercise over the last 12 months. I think everyone was there looking with microcosm as to how they can overcome this pandemic, and that will lead to a massive revival in earnings momentum. India's earnings cycle is finally improving with higher commodity prices, better banking profits, and corporate cost focus augurs very well. It was very much needed as well. you know
Right.
uh, Even though normal GDP has contracted, Nifty earnings have likely grown 20% in the last 12 months. I
Right.
think this, in the overall context of where things stand with global rates and liquidity and improving earning cycle, will see a lot of capital flow into India once we see normalcy back in terms of the case count. So I do believe that, should we see a pullback, nobody can time markets, but I would use any pullback to get back into quality companies and build a portfolio.
Lovely. So thank you, Shiv, for that. We have almost come to the end of this fireside, but there's one more question, in fact, I would like to take up, because this is again very important, especially on the platform that we are speaking,
Yep.
is the key trends that you see in the alternative management and wealth management space. If you can just give us few bullet points, that'd be great.
Sure. I think the biggest trend that will impact India, right, and it's probably started 4 5 years back, is the financialization of savings, right, of the Indian diaspora. And as a result, you will see a lot more innovation and demand for alternative assets within the financial services. And even in traditional asset classes, which have been mutual funds. If you look at the latest McKinsey report, and we have also in Edelweiss done a lot of work, you know, there will be a lot of digitalization and technical innovation that will, funds will have to adopt in terms of technology. The share of investments through the digital channel has nearly doubled from, I believe it was 5% in FY19 to almost in double digits today, right? In fact, every advisory in wealth management is now seeking online, right? According to another survey, nearly 60% of the population that survey expected and wanted online advisory, while 20% preferred omni channels. So I guess, one, there will be a massive demand, uh, and second, in terms of, even if you look at, despite very strong growth in last 5 years in AUM in the mutual fund industry, our retail AUM to GDP is still, the statistic is just as low as 6%, versus almost 36% in emerging markets in Southeast Asia and almost 70% in the US. So we have a long way to go in that regard, right, to catch up to. And I think a big change will also come in terms of personalized investment advice that will become more, based on people's risk appetite and retirement. I think this pandemic has brought about a revolutionary change in wealth and asset management industry, which needs long-term assurance from clients. And I think, clients who will adopt, product advisors, service solution providers who will adopt to the ecosystem in providing a paperless, and seamless in terms of KYC onboarding. I think those are the bigger changes that we will see, right? I think that's what the platform demands in the new world, and that's probably going to be the biggest structural shift in the financialization of assets and savings in India, right? Of course, in the platform that we are looking at in Edelweiss Asset Services, we are investing heavily in technology because we can see that kind of demand from our clients who are providing the end clients, right? From a lot of AIFs, from a lot of PMSs. So I think, as this asset class grows in popularity, you will see a lot of innovation coming into that space as well, right? We
Right.
are probably 5 6 years away from blockchain in terms of settlement, but blockchain settlement is already starting to happen in the US. And that's
Right.
probably the next shift that will happen in India in the next 5, 6 years.
Absolutely. My next question to you, Shiv, was exactly on the same lines. You spoke about innovation and adopting of technology, and alternative is undeniably a very strong asset class already in making. So that brings me to my last question before we open for the Q&A, which Aditya would have. I've been following you on various interesting thoughts you've had on the gold and crypto, both. What is your latest view on these two?
Sure. So, gold has been a bit of an under performer lately. It was under pressure mainly because of which isn't surprising. We had a growing expectation of a cyclical recovery. We saw a massive spike from November onwards in US yields. And gold is very sensitive to that, right? I'm a long-term believer in gold as a protector of, your your purchasing power, and I think over the long term I remain bullish. But the reality is that what last year has shown is that gold has serious competition from the crypto world, right? And also, let's not forget, in finance, momentum is probably the biggest drawer of more money flowing into that particular asset class or product. And Bitcoin, given the performance that it has had and the uptake from millenniums, I think the biggest change for me over the last couple of months has been the uptake in the digital world from institutional clients, especially in the US. You have George Soros and Paul Tudor Jones, and with Michael Slayer coming up and MicroStrategy and putting his treasury fund into Bitcoin. Elon Musk at the forefront in Tesla. You know, a lot of things and a lot of large institutions are putting money into this space, which cannot be ignored, right? There are a lot of naysayers. This is all a bubble and it can crash anytime. But the reality is that a lot of smart people are moving into that world. There is so much to learn in that space. There is token, there is stable coin, there is altcoin, there is NFT, which is non-fungible tokens. So it's just not about Bitcoin and Ethereum, right? There is so much happening in that space. I'm educating on a daily basis as to what excites the millenniums, and why are these prices moving. So I think for this decade, or at least in the short term, that can continue. And the reality is, the blockchain is actually solving real life problems, and the uptake of that will change. And as that becomes institutionalized, I think people will go from naysayers to believers in this. But let's see. It's an interesting space to watch out for. I'm still learning myself.
Lovely. So thank you so much, Shiv. It was wonderful chatting with you. Aditya, if we have some questions from the participants, if you can share it with Shiv, please.
I'll quickly check, Jyoti, although we're way out of time.
We are out of time.
Just a sec. So audience, if you have any questions, quickly use the ask a question tab.
While we are waiting, Jyoti and Aditya, thanks for this. And I just hope everyone's, whoever is dialed in listening to us, is safe, and, are still doing all your precautions. It's not time to put our guard down. Yeah, that's the last thing I would say. That
Absolutely.
I think first wave around, I saw a lot of people, thinking this is going to get over soon. It has taken us, all of us, by surprise, but we need to do what we can, not only for ourselves but our loved ones and our colleagues.
Correct. No, very well said, Shiv. Absolutely. I think things are getting crazier, and we need to keep our guards